Welcome to the B.F. Anderson Technical Report for August the 5th. Peter Lynch, quote, "There's no such thing as a worry-free investment. The trick is to separate the valid worries from the idle worries and then check the worries against the facts." Example, if you go back and check the facts on whether a Democrat or a Republican president makes any difference in the performance of the stock market, I think you're going to be surprised. There's no big deal. When Franklin Roosevelt was elected in the 1930s, the portfolio in his first 100 days went up 75%. So what I'm saying is that you've got to separate things that you should worry about from things that are not worth worrying about. So here's another quote from Warren Buffett. I always like. Rule number 1 is never lose the money. Rule number 2 is never forget rule number 1. So, it's very important to have a strategy where you can deal defensively with the market. So right now we are somewhat defensive, but as you can see here with the NASDAQ, somewhat not really making new highs, somewhat moving sideways, but continues in an uptrend, so we're okay with the NASDAQ. Especially if you look at it on a weekly basis, you can see that the uptrend is very much intact and really no problem whatsoever. S&P 400, which is the mid-cap stocks, we continue to see sideways action. Really kind of a problem area. The market is really not broadening out. The mega caps are leading the market. The small caps and the medium-sized companies are not. It's just the way it is. New York Composite continues to be sideways, no real new highs there. Now on the small caps, again, you can see the rollover. We've had a rollover here in the small caps. They continue to underperform. I would continue to be defensive about small cap stocks. Now on the S&P, no problem. You can continue to see that we continue to be in an uptrend, very constructive pattern. Then on the weekly basis, again, as long as we're above this 35-week moving average, this is a bull market. So we're above the 35-week on the NASDAQ. We're above the 35-week on the S&P. So sleep good at night. We're in a bull market. Now on the aggression index, we are seeing a little bit of improvement. Now the way the indicator works is we have we're comparing the NASDAQ to consumer staples. So we're comparing technology to toothpaste. Now, when the market starts to get real defensive, and we'll talk a little bit about that here later in the video, but you break below this 40-week moving average, it's just telling you that the market is getting incredibly defensive. Because what you have to understand is these large funds out there really don't have the ability to go to cash, but they do have the ability to buy things like Colgate-Palmolive or Procter & Gamble or Coca-Cola, and when they start doing that, it's telling you that the market may be in trouble. But so far, we've had the pullback in the aggression index. It's held the 40-week, starting to perk up a little bit. I think we're okay. Now on interest rates, this is really very interesting. We're down to 1.18 on the 10-year Treasury, which is one of the lowest interest rates we've seen in a while. It's broken below the 200-day. Price of oil somewhat coming down. Financial stocks moving sideways. But interest rates are hitting levels that are quite concerning. Now on the new lows, we'll talk a little bit more about the new lows in the video, but we're under control here. Now, realize this is the leaking boat index, which means, or indicator, which means that if the market is hitting a new high and at the same time you're getting a bunch of new lows on the New York Stock Exchange, it's telling you that the boat is leaking. Well, right now, we're under control. Right today, we're at 33, or as of yesterday, we're at 33. When we get over 40 and the market's making new highs, something to be aware of. Now on the inverted yield curve, we're not inverting, but we are moving in the wrong direction. Interest rates are coming down, which is causing the yield curve to deteriorate. On sentiment, we're somewhat neutral on the sentiment readings, which is an improvement. Now that's a retail sentiment reading. On an institutional sentiment reading, we're still in greed. We'll see how that works out. But it's just something to be aware of. It's a secondary indicator. Now, on the Russell 2000 Growth ETF, you can see the growth stocks continuing to have a tough time here. We peaked back on February the 10th. We continued just to move sideways. Junk bonds are starting to bother me a little bit here. We're breaking below, again, for the second time, we're breaking below the 200-day moving average on this ratio. Now, this is an important ratio. What I'm trying to say here is that when people buy junk bonds, they're very optimistic about the economy because they're not worried about default. Well, this is a ratio of junk bonds to the traditional treasury bond. When the line is going up, people are very optimistic about the economy. When the line rolls over like this, people are getting concerned, or investors are getting concerned. So this is definitely a red flag and a warning. On the volatility index, the market's very quiet. We're not seeing a lot of volatility. We're in good shape there. Now, I did want to point out several graphs here. This is Amazon. You can see here the stock really broke down about 5 days ago on an earnings announcement. The internet stocks are starting to show some real signs of weakness. Now, the consumer staples I wanted to mention, they have been strong, but today you can see they're kind of pulling back a little bit. But the consumer staple stocks have been showing some strength here. However, as of today, we're starting to see somewhat of a breakdown. We'll have to see how that works out. Keep an eye on the consumer staple stocks. Now, this is a graph, a ratio, where I'm comparing the Dow Jones Industrial Average to the NASDAQ, or I'm comparing value stocks to growth stocks. Now, when the line goes down, it's telling you that the growth stocks are outperforming the value stocks. You can see here on February the 10th, we hit a real low on that ratio. And so basically, here's what happens. People will be in a growth strategy or a value strategy. It starts the value strategy underperforming, so they switch strategies. And then about that time, things go the other way. So it's kind of like a dog chasing its tail. But you can see here the value stocks, the growth stocks outperformed, then the value stocks came on board, started to outperform. Now they're underperforming again, and this is a moving average. This is the 200-day moving average. The ratio has broken below the 200-day moving average, which means that growth stocks somewhat are improving. Now, on new lows, I wanted to mention this real quick. The new lows are the leaking boat indicator. You start to see an increase of new lows. It tends to be somewhat of a warning about a possible correction. As you can see here back in 1819, that's what happened. Back here in 2020, we started to see an increase in the new lows. This was the pandemic. Boom, it comes down. Now, we're not seeing that many new lows right now. So I think things are okay in this department. Now, this was another indicator, another ratio. This is where I'm comparing the S&P 500 to the 20-year Treasury bond. This is somewhat of a warning here. You can see here that stocks have been outperforming bonds for an extensive period of time, but we're starting to see somewhat of a rollover here. So just something to be aware of. Now, again, here I have the Vanguard Value ETF versus the Vanguard Growth ETF. You can see here as of February, the value funds started to way outperform the growth funds. Then they pulled back. They continued to outperform. Now it's all kind of switching and going the other way. So the message here is this. You know, you've got to pick a strategy, whether it's a value strategy or a growth strategy. You've got to pick the one that makes the most sense to you, because the key to this game is staying power. So if you get into a growth strategy and you understand it, if you get into difficult times because you understand it, you tend to stick with it. Now, here are the top 5. We do not own these stocks. I'm just pointing out some stocks that are showing some strength. This is Revolve Group, which is a retail stock, breaking out to new highs, looks constructive. This is Alcoa, which is metals. You can see here somewhat of a rally, however, pulling back. Advanced Micro Devices, unbelievable. Look at this thing, just straight up, smoke up a chimney. Looks very positive. Keep an eye on Advanced Micro Devices. Asana, which is software, had a big sell-off here, shook us out. We own the stock. We got out of it. But it's been somewhat constructive ever since. One of the beauties of the liquidity of the market is that if I get out of something, I can get back into it. But so far, I'm not seeing a buy signal in this area. Here's Biotech SE. This is a biotech stock. Again, smoke up a chimney. We're seeing some real strength in some of these biotech stocks. It's up 16% today. Looks very positive. So that's it. If you have any questions, let me know. Thank you very much.